title of today's show, Why Inflation is Not Transitory and the Great Crossover is Underway. Now, when I talk about inflation, it's not necessarily the CPI. What I'm saying is I think we're going to have incredible amounts of money, probably hyperinflationary amounts of money being printed. That doesn't mean that there won't be some major declines or even deflation in certain markets. Certainly, I think the financial markets, we could certainly see some major air coming out of that bubble, and I'll get into that as we move along. I want to bring to your attention something that happened back in 1720 to 1724, the Mississippi bubble, because I think it has a great deal in common with what we're going through now in the United States, only on a much grander scale than happened in 1720. But at that time, Louis XIV ran France into bankruptcy, essentially, with all of his foreign wars. And so they were out of money. And how do we get out of this mess? Along comes a Scottish economist, John Law, who had a plan to monetize the French territory in North America along the Mississippi River in North America. So John Law came along and suggested that, hey, you've got this territory, Louisiana territory. It can be made, we can use that to bail France out. So the French government said, well, sure. I mean, what are we going to do? We got not to lose. So do your thing. So the first step was to create the Mississippi Company and sell shares in that company. The idea was that the Mississippi Company could tap into the untold wealth in that region in North America. The second step was to create the French Central Bank to issue paper money. That was the first time that they had that, when they issued paper money. The British had done that before that, and they had created the South Sea bubble. But the British stuck pretty much to a gold standard, or to some sort of a monetary standard at least, not the French. They printed in incredible amounts of money and did not have the gold and silver to back it. So the French bank then provided the liquidity. They printed the money, and John Law sold the shares of the Mississippi Company. They went from 500 livres at the start of this scam, until 10,000 livres in less than 4 years. So people, much like I would suggest the Bitcoin holders today, they were very happy. But then, alas, what happened? Things weren't so easy as people had thought when they bought the shares of the Mississippi Company. The Mississippi Company lost a lot of money. People started losing confidence. The shares started to be sold. So what was John Law to do? And I would suggest this is the parallel with what we're doing now. The thing to do was to create money to buy shares to try to support the shares. And I think that's exactly what the Federal Reserve is doing now to try to keep the financial markets afloat, starting with the bond market. Because if the U.S. wasn't in there buying treasuries, the bond market would most certainly collapse. So it didn't work out too well. We started having hyperinflation as a result of massive amounts of money. People had all this paper. They go back to the bank. They figure they can get their gold for it, get real money. It wasn't there. The massive amount of paper just couldn't be matched with the amount of gold that was in the treasury. And so people really lost confidence, and the currency went to the dustbin of history. This, I think, is something that we don't, this is human nature. We like to hear what we want to hear. And the idea that John Maynard Keynes came along and said, we can print money, we can print our way out of trouble. Governments can deficit spend. Saving doesn't matter. We just have to keep the demand side of the economy going. And if you don't want to work, we've got a check for you. Don't worry. And people like that. We as human beings like to take the easy way out many times. And so we did. 1971, when the United States didn't want to tax to pay for Vietnam and for socialism, Nixon took us off the gold standard because the French and others were demanding gold. The French apparently learned their lesson from John Law. They wanted their gold, and the gold is disappearing from the U.S. coffers, and so Nixon slammed the gold window shut. And then we can see what's happened to the debt that's taken place since then in the United States, up to 28 trillion now. Trump started off at about 22 trillion, and now we're on an exponential road. I want to play this little clip from CNBC. Joe Kernan talked to Stephen Druckenmiller. Go ahead and play that.
And 85% of the transactions. Let's talk about the dollar. And 85% of the transactions are still done in the dollar. You pointed out in a recent speech that you think we've crossed the Rubicon. Are you comfortable saying what you said there, that for the first time in your career, you think we lose reserve status at some point?
I'm comfortable with it. That's my central case. As you know, Joe, I can change my mind. But yeah, you said that to some extent the Fed is enabling the fiscal transfers. It's not to some extent. They couldn't be doing this without the Fed. The Fed is monetizing their activity. I mentioned all the QE after vaccine confirmation and retail sales. We've had 850 billion of direct transfers. 575 billion of them came after retail sales were above trend. 575 of the 850 billion. I'm old enough to remember the bond market vigilantes. I used to be one of them. Without the Fed buying, I don't know what the exact number is. I think it's 60% of all the debt issued. The bond markets would be totally rejecting this. So they are enabling this massive expansion in fiscal policy. And the problem is, if you end up getting inflation, and frankly, even if you don't, the debt is going to be so big. You remember I did my entitlement talks 8 or 9 years ago. That's all happened except for one thing, the interest rate level. So we're right now in the crux of when the baby boomers accelerate in terms of getting Medicare, Medicaid, Social Security, that stuff. Right as we're doing that, we just put $6 trillion of new debt on. Again, all enabled by the Fed. These guys could not be doing it. Bond rates would go to a prohibitive level. So my issue here is, in the future, as we go forward, do you have chart 5 up there? It's federal spending, Social Security and major healthcare programs. Federal spending is percent of GDP. This is the CBO. This is not me. Okay, and they're saying if 10 years go to 4.9%, which is their normalized projection, the interest expense alone will be close to 30% of GDP every year. That's basically what we just spent on the COVID emergency in the last year. There is no way we can afford to have 30% of all government outlays be toward interest expense. So what will happen is the Fed will have to monetize that. When they monetize it, I believe it'll have horrible implications for the dollar. And that's why I said in that speech, yes, that I think it's more likely than not within 15 years we lose reserve currency status.
So the issue is we're printing money to enable the massive amount of spending that's going on. Otherwise, the Treasury market wouldn't be able to take it. We'd have a crash in the Treasury market, a crash in the equity market, no doubt. And the main problem that we have now is that the foreigners who had so long used their trade surplus dollars to buy treasuries are no longer doing that. The chart that you have in front of you shows the foreign interest or the foreign buyers of treasuries. They've disappeared, essentially. In fact, at the bottom of the chart, you can see they've actually reduced their spending, their purchase of treasuries. And so it's left to pension funds and the Fed. The pension funds need liquidity, so they're in the treasury market. There's no real reason to own treasuries when they're negative real rates. But this is the predicament that we're in, and the Fed has to print enormous amounts of money, especially with the massive amounts of spending that's going on now. And we can see that last year, pretty much all of the new money that was raised in the Treasury, the blue line is the Federal Reserve, it was financed by the Federal Reserve. So we're monetizing everything now. We're doing what the French did in their very short-lived effort to hold up the Mississippi share price. The problem that we have is that when we deficit spend and when we pump money into the system, it's becoming less and less efficient. Whereas back about the time we went off the gold standard, it was close to a 1-to-1 level. Now it is $4.5 or so of new debt to get $1 GDP. And so we've hit the new high. We're above World War II in terms of debt to GDP. And one of the problems that's occurred, especially since the financial crisis, is that we've gone, essentially the banks are no longer lending into Main Street. And so the red line is the deposits that are going into the major banks, and they're just simply not getting out into Main Street. And this is Obviously, part of the middle class, which is really declining, and joining the poor at the bottom of the system to a great extent. So there's an easy answer, of course. Tell me lies, tell me sweet little lies. We can just print money. So we're on Ben Bernanke's helicopter money now. We're seeing it with the checks that are going out to millions of Americans. Free money, right? And don't worry, we've got an answer for everything. But what it is having an effect on people, smaller businesses are having trouble getting people to go to work. This is a chart showing different sectors. Some can make a little more if they went to work, but they're going to work and they don't have the time to do other things. So this is really a problem. This was sent to me from a friend down in Florida who saw this on a restaurant window. People aren't going to work. They're staying at home, sitting on the couch or doing whatever. They're not going to work. So there's a shortage of labor, which will exacerbate the inflation problem on that side of the equation. The main question is, can the Fed really hold down interest rates? Are they going to be able to control them? We can see the sharp turn up in US Treasuries after commodity prices started to rise dramatically. And that was a turnaround in March of 2020 with the lockdown, the pandemic lockdown. The Fed did a turnabout, it was a Powell pivot, and started quantitative easing again. And we started seeing a rise in interest rates. I should go back to this slide just to show the golden crossover, suggesting that we are in a bull market for Treasury yields now, that we can expect. I think the pressure is certainly on the Fed to print more and more to try to cap the rise in interest rates. The problem is that we can't stand higher rates. And so with each of these new debt levels that we reach, the interest rates cannot go higher before things break down. So the Fed's been able to, as long as the dollar survives, to be able to continue to pump in more money and keep the interest rates lower. This is a chart just showing what happens when the equity market starts to crash. Lower rates and it goes back up. The COVID crisis smacked us down really hard. And so the Fed cut rates and now they're going back up. But the equity market seems to be having some issues right now, possibly a topping pattern. It seems to be the case. So is 1.7 the break-even point? Who knows? This is just to show the inflation, the different items. The only items on this chart that didn't go up is the trade-weighted dollar, which lost 11 from March 20th to April 26th, lost 11%. I keep track of something I call my inflation deflation watch. James Turk tweeted this out recently. There's not time to tell you right now how the components of this and explain the rationale, but it is basically to try to determine whether the system as a whole is inflating or deflating. And this includes stocks and commodities as well as bonds in this index. The CEOs of companies have been warning about inflation. This is showing the number of times 800% jump in the mention of inflation on conference calls by CEOs. And you can see they were signaling the CPI is going to head up, and lo and behold, the numbers we just got suggest that that's definitely happening. Is this a long-term trend? Well, Goldman Sachs is showing what they're predicting in terms of quarter-over-quarter GDP. Yes, we're going to have a strong quarter now, but then they see it declining. Of course, this is a big bounce back from COVID. How real is it? That remains to be seen. Will inflation also come down with this? That remains to be seen as well. The CPI, but again, the inflation in terms of the amount of money that's created is not going to decline in my view. Equity markets are at all-time highs using Warren Buffett's indicator, corporate equities to GDP. I show this slide only because Goldman Sachs is talking about the industries that are cheaper than the market and those that are more expensive than history. And so we're looking at metals and mining down there in the lower left quadrant, suggesting that metals and mining are both cheaper than the market and cheap compared to history. So just sort of summarizing here, the Mississippi bubble, they printed money, forgot the honest money with gold. tried to prop up the Mississippi share price. On a much grander scale, the United States is doing this now, and as a global currency, doing this globally. But it's the same sort of idea that the Fed has to print money, endless amounts of money to keep the financial markets from crashing. And so I think we're on a one-way street towards, I think, oblivion. Whether it's 15 years, as Druckenmiller suggests, the dollar is going to collapse at some point in time. The whole existing currency system is going to go out. One thing we know is that gold holds its own. I show this slide because I want to point out that we could have what I think is very possible. What we could have is a similar situation to the 1970s. The Fed was behind the curve on inflation. They raised rates, but not fast enough. The inflation kept rising and going up much faster than the rates. So you had negative real rates, even though the nominal rates were rising. Gold did extremely well, as you know, rose all the way up to $850 until Paul Volcker then got ahead of the curve and raised rates to such painful levels. My 17.5% mortgage, the first mortgage I had, that slammed gold down really hard, and people could actually have confidence in the paper. They could actually get some reasonable wealth out of the paper when they did that. That is when Volcker raised the rates to those levels. But I don't see how that's even possible now. I just show this chart. I like to keep track of monthly average gold prices. And this shows all the way back to 1995 when I worked at ING Barings in the metals and mining department. We did this chart. And here's where we are now. So we've bounced off this bear market. I think we're on to a real bull market in gold, a substantial one. We come down and kiss that 20-month average and bounced off, and it looks like we're off to much higher prices right now. Ottavio Costa with Crescat Capital put this tweet out. 73% of the top 50 gold and silver miners are now profitable on a free cash flow basis. That's the highest level we've ever seen. He says one thing is clear that miners continue to improve their margins, tighten up their cost structures, and generate more money than any other time in history. So I think with that, that's basically what I have to say for my part of the discussion today of our conference. I think we are onto a time when I think it's a bull market of a lifetime. I'm 74 years old and I continue to work. I can't walk away from this bull market because we're seeing a substantial amount of money raised that's going into the ground, and we're seeing some fantastic results. And I'm really pleased to have the companies here today to talk about what they're doing. Goliath Resources, it's in the Golden Triangle. Clinton Henning will talk to us about that shortly. Gold Source Mines is working on moving a project towards production. That's a saprolite and fresh rock project in Guyana. They're doing very well. I think it's under the radar screen. I don't think too many people are paying a lot of attention to it, so I'm happy that they're here because I think it's very undervalued. White Rock Minerals, Quentin will be here to talk about that as well. He sees an orogenic epizonal gold-hosted structure, possibly one that could be very exciting, I think. And this is White Rock Minerals is an Australian-based company. They trade in the United States, not in Canada, but Dr. Henning will talk about that. Firefox Gold is in the Lapland Greenstone Belt in Finland. Very underexplored, although now coming into its own with Agnico Eagle and some other majors. But there are just a handful of juniors, and Firefox Gold has an awful lot of great prospect there, I think, and we'll learn about that from Patrick when he talks to us in a few minutes. And then Newfound Gold Corp, no doubt everybody knows about Newfound Gold. Spectacular results on its Queensway project in Newfoundland. I suppose in the minds of many people, they're wondering how much higher can this go with its market cap where it is. But I think one of the reasons I wanted to have them here is because I think that it's much bigger, potentially much bigger than people realize. It's much anyway. We'll let the company talk about that.